Welcome to the Become Sensible podcast, where we discuss practical accounting, finance, and tax for everyday business. I'm your host, Fiona, and I'm here to show you that no matter what your business financial situation is, you can change it. Good morning. Thank you so much for tuning in to Become Sensible. My name is Fiona and I am your host. Today we will talk about how to estimate the tax as business owner. I think this topic is not interesting, but it's actually covers so much in terms of basic tax compliance for you. Whether you are like a business owner, self-employed, or freelancers, or you have a large income outside of like a regular wages, understanding estimated tax is important for your overall financial health, because no one actually like to have a surprise tax bill, especially a large one. So in the next 20 minutes, we will talk about why we need to pay an estimated tax, when they are due, what are the minimum to consider, and the strategy to choose payment amount. So let's begin with the fundamental why we actually need to pay an estimated tax. So the United States tax system actually operates on pay-as-you-go basis. It means that government expects you to pay tax on your earned income throughout the years rather than on a one lump sum when you file your tax return. When you go work for a company as an employee, normally your employers will withhold the payroll tax liabilities on your paycheck, and they deposit that money into the government agency every time they run the payroll. But when you have your own business or you have a large portion of your income from other sources of income, such as like capital gain, rental properties, or like dividend and interest, there's no withholding tax on this earned income. So you basically like are responsible for making these payments by yourself. That is where your estimated tax comes in. So estimated tax allows you to pay your tax liability in the installments throughout the year, and it's basically like very similar to the regular employee. But normally regular employees, they withhold every single pay stuff and it was deposited to the government right away. But you as a self-employed or have a diversified income, that is how estimated tax work, and it's work based on the quarterly. So this is serve couple purpose. Number one is ensure that the steady flow of tax payment revenue to the government. Yeah, of course, government need your tax payment. Number two is prevent you from facing a manageable tax bill when you file your annual tax return. Number three is avoid the penalty for underpayment tax. Of course, because government expects you to pay on time and regular and on the quarterly basis. So anytime that you like not based on time and not based on the due date, they will calculate and impose a penalty on interest, because that is how they can make sure that people pay on time. And again, the government, even IS or your state agency, they don't actually want you to pay on April 15 when you file your annual tax return at all. They expect you to pay throughout the year, and that is how you compliance with them and avoid like penalty and interest. So let's talk about when is the estimated tax due. So the first quarter is due on April 15 and is covered for the income that you earn from January to March 31st. And then the second quarter is due on June 15, and that is covered for the period from April 1st to May 31st. And then the third quarter is on September 15 and is covered for June 1st to August 31st. And the fourth payment is due on January 15 for the income that you earn from September 1st to December 31st. And note that these days can shift like a little bit due to like the weekend or it's holidays, so it will be due on the next business day. It's important to understand that these not suggest the payment dues, but it's actually the deadline. It means that the deadline that you need to pay on by that time. Anytime that you pay later than the deadline, they start calculate the estimated tax, penalty, and interest. For example, if it's tax due on September 16 this year, but then you pay on October 31st. So there is the gap between September 16 until October 1st. Whatever the number of the day, they will calculate like how much is the total income during that period. They calculate based on the interest and penalty. They have a like schedule rate, how to calculate it. And so that basically, like, remember, is due date. It's not like optional at all. You can base your estimated by quarterly, monthly, even bi-weekly to have them like manage their cash flow, and you need to pay it by the deadlines to avoid the penalty for that period, for that quarter. So when it comes to estimated tax, there's certain minimum that you need to cover. Number one, the general rule that you must pay 90% of your tax liability of the current year, or like 100% of tax liability of last year. So for example, like for year to date, we make an even number. Your income in like year to date is $200,000 of net profits or like taxable income. So you need to pay, and on that, your tax due, tax liability, for example, $20,000. So you need to pay at least 90% of that $20,000, which is $18,000, or whichever is smaller. Or last year, for last year, when you filed a tax return for 2023 Form 1040, your total tax liabilities were, for example, $30,000. For example, like that. You compare $30,000, which is 100% of last year's tax liability, and this year to date is $18,000. Whichever number is smaller, that is your obligation, minimum that you need to pay to avoid the penalty. The best way to actually have a professional do like a CPA or accountant have you to do like an assessment that calculate for your real liabilities based on your year-to-date earning. And then from there you can choose whether you want to pay like 90% of this year or 100% of last year. But have a real version that actually plug into the numbers like, okay, how much is the net profits, how much is year to date your wage earning, how much is like dividend interest and all the other thing. And they calculate a overall estimated your tax liability. And then you can compare and choose whichever of them meet the requirement. We will normally say that you just save 30% of any of your earnings to pay the tax, which is sometimes is not accurate because your tax in terms of like Social Security tax, Medicare tax, and depends a lot in terms of like the structure of your business, like whether you're S corporation, C corporation, or is a single member LLC. The tax structure go with is totally different. And then like whether it's from your investment, capital gain, this tax different from your ordinary income. So basically like need a real assessment and calculation to make sure that your estimated tax actually accurate. And also there's some nuances in the rule. Number one, if your adjusted gross income from previous year was over 150,000 for a married couple or 75,000. If you single or like married and file like separate, you need to pay 110% of your previous year tax liability instead of like 100%. If you expect like less than $1,000 in tax for the current year after subtract like any withholding and credits, you don't need to make the estimated tax payment. But I know that most of the time the people who self-employment and people who like have other source of income, that they never actually fall into this category at all. Number three, like if you didn't have any tax liability in the previous year, meaning that you didn't have to file a return because your income was so small, or you had zero tax liability, you don't need to make an estimated tax for the current year. But most of the time, because you self-employment or you run your own business, normally this also like hardly fall into your situation. So it's crucial to like accurately estimate your liability in terms of tax to ensure that you meet these minimum requirements. So now talk about like the strategy of choosing payment amount. Number one, you need to determine how much you to pay estimated tax. Number two is use the last year tax as the baseline. So if your income like similar and stable throughout the year, use last year as the tax liability is as the guides. And remember to pay like 100% or 110% for higher earner for last year tax liability to avoid the penalty. Number three is have a project your income and spend. If you have like your business make so much more money, or there's so many movement part in your income this year, I suggest that to have a professional like do a projection your income and like make a real calculation. And this is why if you have a bookkeeping done right, you actually have a number to estimate, to like make the calculation. Your CPA, your accountant can easily make the estimation for you. And then it's also like other source of income, you track it, whether that is capital gain or dividend or distribution to you. Also, number four is consider your income timing. If your income changes throughout the year, you might benefit to have an annual income installment method. And one other thing is normally in tax plannings, my client usually like come to us like the last quarter of the year, because that is where you almost like know exactly estimated like how much is your income, your spend, your profits, how much is other sort of income. This is most of the time like reflects the best about like your earning, and at that time you calculate it almost precisely look like how much you will owe when you file a tax return. Of course, like there's some other strategy, but if your tax is complex, you need to have someone actually have a tax planning section with you, because there's ton of code and regulation that actually motivate you to actually have you save in terms of tax rather than just pay to the government. And so the goal is not just paying up, remember. And there's some people like they say, okay, they know the number now. For example, if they owe like $40,000 or $30,000 in tax, they just save the money and they hold on it until they file the tax return and then pay, and they accept that they will pay the penalty interest at that time because they want to use that money to do for like other things that generate more income and cash flow. That absolutely depends a lot on your tax situation and your cash flow situation. Like that is why I say like tax is, or even financial is very personal, and it need to tailor to your like specific situation. Is the fundamental is similar, but like everyone have a different situation, and it should be like tailored to your situation. Some people don't want to like give to the government like the money throughout the year, but some people will feel like scared and fear when they have like a huge tax bill. So it's absolutely depends on your tax situation and your cash flow situation too. So you choose, it depends on your situation. So in conclusion, today we talk about a lot about estimated tax, why we need to do it, and what's the minimum to consider, what is strategy to do in terms of tax. And because tax or any financial situation is a very personal situation, and there will be like very hard for me to say like, okay, you should do A, B, C, but there's always the standard and the requirement that you need to meet. And in terms of like how to actually calculate, plug in the numbers, I just advise that if your income is complicated, should have a professional that who can actually use the software and calculate for you. You spend like 10 hours to like try to figure out like what is your estimated tax. It just doesn't worth the time, and there's software to help you to do it actually faster and more efficient. And if like a great professional also will give you the strategy how you can do certain things that give you the best solution for your tax situation. So thank you so much for tuning into the episode today, and I hope you found this information is helpful. Remember, your next estimated tax due is on September 16th, And let me know if you have any question, comment, and subscribe and follow us. Thank you so much for your time today, and I'm looking forward to future episodes with you.